Good afternoon. Hello and welcome to all the participants. We have participants not just from India, but from different parts of the world. So good morning or good evening, maybe, depending from where you have logged in. It's my pleasure to welcome all of you, each one of you, to this very, very important webinar on decoding FCRA rules 2020 and the forms associated with it. My name is Sandeep Sharma and I work in FMSF. FMSF is a technical organization which specializes in the areas of financial management, legal regulations and governance issues. Welcome once again. Today in our midst, we have a very esteemed panel group consisting of Mr. Suresh Kejriwal, a chartered accountant by profession, having long years of experience of working with the voluntary sector. Welcome Sureshji to this important webinar. Then we have Mr. Manoj Fogla, who is a chartered accountant and a lawyer by profession. He's an author, probably the best legal mind in the country as far as non-profit laws are concerned, ardent supporter of FMSF and one of our very important colleague. And then we have Dr. Sanjay Patra, who is the executive director of FMSF, a chartered accountant by profession, having more than 2 decades of experience of working in the development sector. And with these kind of panelists that we have, I'm sure this afternoon is going to be a very interesting and enriching one. As you all know, FCRA Amendment Act 2020 came into effect from 29 September. And then on 10th of November 2020, new sets of rules came in. So this webinar that we are doing is in the series of webinars that we have done in the past. We did 2 webinars in the past, one on the amendment bill that was there at the time of the bill, we did it, and once it became an act, we had done. And this is the 3rd one in the series, which is specifically going to focus on the rules and the forms aspects of it. Nevertheless, I think it is important to also understand and look at some of the larger issues with regard to FCRA and the ramifications it has on the voluntary sector. And therefore, what I would like to do today is, discuss the larger aspects as well as get into the finer details, dive into understand the nuances of the rules and the forms. So broadly, the webinar is scheduled in this manner. In the beginning, we'll have a larger level discussions around larger level issues. Then post that, we have broken down this whole the amendment that has come into 3 phases. One would be on registration, prior permission renewal, would be one block. The other block would be bank account and administrative issues. That would be the second block. And the third block would be declaration, reporting and intimation. So these are the 3 blocks under which we are going to cover all the aspects that are related to the amendment that have come in both in the act and the rules. So that's how the program is scheduled. And once these 3 blocks are discussed, then we will have a question and answer session. And I would invite you and request you all to put your questions in the chat box as we have done earlier, and not in the question and answer box, because my team here would help me in compiling the questions so that I'm able to take up these questions to the panelists. So that's the broad schedule for this afternoon. Now, without much ado, to begin with, I would like to invite Dr. Patra to please come and share some of the larger perspective around this whole FCRA. Once the amendment came into effect from 29 September and then now the rule, a lot of churning has already happened in the development sector. A lot of triangulations are being looked at, worked at. So in this context, I would like to invite Dr. Patra and share with the kind of knowledge that he has a perspective around how this whole evolvement has happened and how do we see this whole into some kind of perspective. So welcome, Dr. Patra, over to you.
Thank you very much. It's a pleasure and a privilege to be together in this manner. And as I see, there are more than 550 or so people, and still people are logging in by the minute. And it's good to be here. It is a 3rd one in the series. My colleague, Mr. Sandeep Sharma, thank you very much for hosting it this afternoon. Sandeep is a thorough professional with a lot of expertise in the areas of financial management, governance and compliances, with a high sensitivity to the developmental issues and he works as the Director of Programs with the Financial Management Service Foundation. Well, as he has already mentioned, we will be looking at the larger context or an overview of the FCRA law before we go into the nitty-gritties of it. So this few minutes, I'm going to take you through setting the context of the FCRA law, or we need to understand the broad context in which this law was set up. So for that, let us look at the preamble. What does the preamble of the law says? Why this law has come into existence? And if you look at the preamble says it's an act to regulate certain things. I'm not quoted fully, and to prohibit few things. And very importantly, any activities detrimental to the national interest and for matters connected therewith or incidental thereto. It's very important that we remember in what context this act has come into existence. It has come into existence to prohibit, to regulate and to prohibit, and any activity is detrimental to the national interest. So this whole thing of national interest and detrimental to the national interest has to be kept in mind as we proceed. Now, what are the challenges within this law? You know, there are certain overlaps and overreaches in the law, which I would like to point out to all of you. Now, overlap and overreach of the law. The first thing is that what I would like to point out is about approval regarding change in key members of the association. Now, remember, we said any activities detrimental to the national interest. Now, when we come to approval regarding change in key members of the association, we need to understand that there is an incorporation law. The purpose of the incorporation law is to incorporate the organizations, and it governs the board members, the registered office, the name, etc. So it's quite difficult to understand that how come another law which comes later after incorporation law in a way overrides the incorporation law. For example, the company law or the Societies Registration Act or the trust laws. So they would actually determine and approve the change of board members, name, registered office, etc. However, now this law, FCRA law, also now in a way has said that they would approve the change of these. And so this is somewhat, it is a bit of an overreach into the other laws. Now take for example assets and unutilized FC funds to vest with the prescribed authority in case of cancellation, surrender or non-renewal of registration. Now an organization is being incorporated body. It is an artificial legal person. It has the right to hold properties, assets, its titles. Now the punitive action in the amendment, fundamentally it challenges this concept. It is even more serious when there is no apparent violation. So there is no apparent violation, but if there is non-renewal of registration for some reason, the asset would vest with the prescribed authority. So this somehow, it looks like an overreach of the law. Moving on. Now, there is also another problem with this law is that there is act, there are rules, there are notifications, there are public notice, and even there are forms. So each of them prescribes something. Sometimes rules override the act. Forms prescribe something very different. So there are lots of these kind of things, and I would like to quickly give you some examples. You know, Darpan ID is now made mandatory. It was earlier mandatory, then it became optional, and now through a public notice it says that the Darpan ID has been made mandatory on 23rd of November. The public notice, it has made it mandatory, even though the Act does not seemingly say so. Intimation change to approval. You know, this is again something which we need to also be thinking that, like I mentioned in the previous slide, that there are certain intimations for change of key members or name, address, or key members of the association. Intimation, that the Act says intimation. However, in the rules that has come on 10th of November, it has said approval. So in a way, rules have overridden the Act. Now, the definition of organization as organization of political nature, if they are doing political activity, that has again come in the rules. This is not there in the Act. Compounding of offense, it's a notification. It has come as a notification separately. And then in the forms, in the FC4 form, in declaration number 14, now in the form prescribed, it says about organization managing another organization, supporting, financially supporting. So again, that is nowhere in the Act or the rules, and now it has come in the declaration as managed. And the problem is that there are no clear definitions of managed. And so it could be selectively interpreted. Or even if you say, you know, what we discussed about vesting of assets or unutilized foreign contribution, in case the registration is not renewed, is there in the rules. So there are a bundle of Act, rules, public notice, forms, notification, all this together make it quite a complex scenario. And therefore, there are loose ends where it could be interpreted selectively. Quickly moving on, micromanagement. You know, when we look at this whole subgranting, now subgranting is not allowed. The law is saying that administrative expenses is now capped at 20%. Now, what is it happening? Please remember that what we said, the preamble, that it is any activity is detrimental to the national interest. How a subgranting is detrimental to national interest, or capping administrative expense at 20% would be detrimental to national interest? Because subgranting is an accepted practice. It's an effective instrument where the reach is up to the grassroots levels, and also there are clear contractual conditions by the donor agencies with the reporting mechanisms, etc. in place. It is quite a well-developed mechanism accepted in other laws. For example, income tax law allows it, but subgranting has been now not allowed in this law. Or even administrative expenses to be capped at 20%. There are no, the rule 5 is also there, and there are a lot of confusions around it, which probably we'll also try to discuss. Finally, violation of the law by the FCRA department, and this is very important. You know, law cannot work only one way. There is a timeline for disposal of applications. You know, FC3A, 3B, 3C, the registration, the prior permission or the renewal, there is in the law it says within 90 days the application will be disposed of, and the reality is that never it happens within 90 days. It goes for months, even sometimes years. But there is no penalty. Now, but in FC4, which the organizations have to file, if you make even a slight delay, there is a penalty. The compounding penalty is 5% of the FC receipts of 1 lakh, whichever is higher, and there is a compounding fee of 3,000 rupees. So it looks like the law will only apply to associations, but it would not apply to the law implementing authorities, and that is somehow looks very different in that context. Now, this is the last one I'm going to talk about, is that appellate levels. Now, if you compare income tax law, there are two levels of appellates before it even goes to the High Court and the Supreme Court. Whereas within this law, there is only one revision petition mentioned in section 32, which is an ineffective instrument. We have not had the experience where there's some relief has some redressal has happened. So grievance redressal mechanism is totally vested with the judiciary. So therefore, if you are not getting the justice or if you feel aggrieved, the only mechanism that you have is to go to the judiciary or the courts, and it may take time, and therefore the organization may be in difficult situations. So these are some of the broad challenges and the broad context of this law that I wanted to bring it to your notice. Now it's over to Sandeep.
Thank you, Dr. Patra. I think this was extremely informative and useful, to critically examine the various facets of the law. And you looked at the issues of overreach, how it is happening, whether the appellate provision within the law, to what extent it is there, and how, one forms or rules overrides the act. So, you brought in those perspectives. But what interestingly you also brought in was the issue of nexus between the preamble of the law and the kind of amendments that have come in. And it is in this context that I would like to bring in Dr. Fogla, who is our principal speaker for the day. And I would like to ask you, Dr. Fogla, we will have about 15-20 minutes to discuss around these issues. The first question that I would like to ask you is that, considering all these changes that has happened since this act was promulgated in 1976 and the various amendments that have come in, what do you think? You are a legal expert and you hold a wide range of understanding around non-profit laws. What do you think? What kind of pattern is emerging because of the changes that you see? And tell us, what could be the objective of the government in doing all these changes that they are bringing in? Dr. Fogla.
Yeah, good afternoon, everybody. So my understanding, as Sanjay has been telling, that any act, when you look at the act, you analyze the act. So you first look at the act, the original act, why it was enacted, what was the need for enacting that act, and what is the preamble. So to talk about arbitrariness of any statute, what we in legal term we say that embedded arbitrariness. Is there any embedded arbitrariness? And what is the intent? And is the intent really fulfilled or achieved by the government by making these? Are the amendments in sync with the various objects? If you see the preamble of 1976 Act, the preamble said that primarily it was to regulate associations, and associations should work and their work should be consistent with the democratic and sovereign values of India. So and there was a more aggressive preamble in 2010, and the preamble said that to regulate anything which is not in national interest. So a negative and a more monitoring type of element was embedded in the preamble itself. It was quite a benign preamble in 1976. And in 2010, we see a preamble which says that we should, the government will ensure that the association, persons, individual, anybody receiving foreign contribution should not be acting or doing anything which is not in the national interest. And if for any law-abiding or any citizen of the country, this is what we would expect. I as a citizen, I would expect that government is capable and bringing up with prudent laws so that the national interests are protected. But the question is that, are we really protecting our national interests with the kind of changes we are bringing? For instance, if you see the 4 or 5 changes which have come in the last 2-3 months in the act, in the rules, and in the forms and declarations. The first fundamental change, if you see, which has created a paradigm shift in how the charity are working and probably will work in times to come, is that inter-charity donation is not permitted. What is inter-charity donation? When the money comes into India, the first recipient there is no national threat. But if the money goes to a second recipient, there is a national threat, or it is not under interest of the country. So that is something which is beyond reason, because when this act was debated in 2010, the late Mrs. Sushma Swaraj, who headed a standing committee, her committee argued before the parliament that the proposed amendments regarding not allowing FC money to unregistered organization. So, that itself was not a good decision, because it will stop money from percolating to the grassroots. So there is a contradiction. On one hand, the law says that money should be stuck with the larger NGOs. They themselves should apply it. It cannot go to the smaller NGOs on one hand. And on the other hand, the law says that the money should be applied only on direct activities, and larger NGOs are not expected to do direct activities. They work through various kinds. So there is a contradiction in the law itself. And if there is a national interest risk, then the risk should be more at the first recipient. How the risk it becomes a risk when it goes to a subsequent recipient. So the money coming first recipient is safe, and the second recipient or the subsequent recipients are not safe. That is something it doesn't match with the explanation and the law. So that is how it seems to be an arbitrary way of regulating the charitable organizations. But to my mind, FCRA law is being used like a charity regulator rather than an FCRA law. And if a charity regulator has to be created for the country, then the charity regulator cannot function from one office with 5 or 10 people sitting in one particular place in Delhi, where under FCRA itself there are 23,000 organizations after so many cancellations and non-renewals which has happened in the past. We had 40,000 organizations in the past. So the structure is that you cannot have a direct interface. So that is one. If you see now admin expenses. Now FCRA law in 2010, these two things came: admin expenses and political activities. Fortunately, this time the political activities have been redefined, and it has been told that political activity has to be actually political activities. In 2010, when the law came, law and order situation was treated as political activity. It said that if you make a bandh or a rally or a rasta roko, then you will be deemed to be a political organization. But actually, a rally or a bandh are tools used by political parties, but they themselves are not political activities. So therefore, there was quite an inconsistency in the law and the reason, and that has been corrected this time. And this admin expenses was brought in. So now admin expenses, you have to understand that admin expenses, under the assumption that it is a genuine expenses and it has been applied for the purposes. So once the expenditure is genuine and it is applied for the purposes, then saying that I will allow you only 10%, 20%, there is no reasonable nexus with national interest. A reasonable nexus with national interest could be created if it is found whether admin or program expenses are used for purposes other than for which they have been brought into the country. So that would have been a more proactive way of finding out mechanisms. If the government, we don't know what kind of finding they have, which has necessitated this kind of changes. So suppose a particular kind of organization or particular kind of activity doesn't seem to be in our national interest, then after a thorough debate, those kind of activities should be banned. If some specific group of donors don't seem to be in our national interest, we have had no qualms, no hesitation in blocking so many apps of Chinese companies. It is very difficult for Chinese companies to invest in India. There are various other restrictions from overseas investments, FDI, etc., wherever our risk is. But under FCRA, there is no formal restriction. Even today, we hear that 72 or 73 donor agencies have been put under PRC list. PRC is a provisional reference category. That means there is some secret direction given to Reserve Bank of India and the banks that not to credit any funds received from such donors. But why not put them on a directly prohibited category, so that other organizations and other donors will not face any problem? So these are obviously there are embedded arbitrariness, and there is no reasonable nexus between the object of the FCRA and the recent changes. Even the bank account changes, even the changes pertaining to governance. So now a change pertaining to governance, one to some extent can understand if a foreigner is on the board, it can be regulated. That was always there. But any board member, that change has to be approved by the FCRA department. I'm afraid that cannot be the mandate, and that would be clearly in violation of our constitutional principles. So these are some, because when we see arbitrariness, we see the act itself should be in alignment with the constitutional provisions and the preamble itself, and the rules, forms and circulars should come out of the act. And many of the rules, the forms even today which we have, we don't find a section under which those provisions can be related, whether 75% of foreign donor, for instance, for prior permission, 75% control of foreigner has to be declared. So now that is, to my mind, a liberal thing, that up to 74% foreign control is allowed for prior permission. But why that has not been extended to registration and other things? But procedurally that in the past has been being followed. So a lot of things are given to the discretion of the authorities and to the circulars and FAQs which are not consistent with the act. So this kind of arbitrariness is the larger pattern which we see, that FCRA is coming as a charity regulator for the country rather than an act working for national interest. So it is working, a mandate looks to be much more than a national interest. It is about regulating the charities, their funds, and that also is questionable, because charities, unless substantially controlled or funded by government, are private institutions for public purposes. So there are so many instances, so many legal precedences where charities cannot, the interference into charity, even today RTI law does not apply to charity in spite of the public money they use. They are not under RTI law. So when all other laws provide that enabling space for the charities to work, then FCRA laws should confine only to national interests. So only to the extent it can be justified that these are the three things which clearly are not in the interest of our country. Those are the laws which are acceptable. Otherwise, they look quite arbitrary. So this is the larger pattern, that it is more of a regulation over charities rather than national interest.
Right. Thank you very much. I think a couple of places you mentioned about charity regulator, and it is already in the newspaper that the government is planning to form one, charity regulator for looking at the, foreign funding issues. Well, that's a different aspect. Dr. Fogla, you also talked about this inter-charity donation, inter-charity grant and amendment to Section 7. Now, in this context, large organizations or big donor organizations who primarily work through local NGOs, grassroots level organizations, what is the way out for them? How do you see it? What can be done now that inter-charity granting is prohibited?
Then inter-charity granting is prohibited. So then one is the long-term issues. So one has to come to in terms with the reality. If the law does not allow, it does not allow. If you cannot do a thing in a particular way, even if you believe that was the right way, but the law doesn't allow. So there is nothing good or bad or irrational about the law. Law has to be followed. But the short-term issues are more important. In the short term, if a charity contract was there, one has to be very careful about taking up these contracts. Now, many agencies are implementing the programs directly. Many agencies are contemplating using the assets, the staff, the infrastructure of the implementing organization directly. So now one has to, few things I may just sound maybe to the donor agencies working with larger partners who need to rework their tripartite contracts, and the mother NGOs who are working with many organizations. One, they should formally close all their existing contracts, and their unspent balance may not be the unspent balance which as per their bank account, because for closure of the account there might be some issues. All staff contracts at the implementing partner may have to be closed arbitrarily. So today you think that your unspent balance is the closing balance and you issue a letter. Tomorrow there is a litigation from the staff side. Then under the tripartite contract, the mother NGO will also be implicated. So now all mother NGOs should sign a closure agreement with all the implementing partner, and they should sign and agree to keep each other protected from any other future litigations, because arbitrary closure of accounts, vendor payments, staff payments, payment to beneficiaries, etc., all will be stopped and halted at the implementation partner level. Some partner may have some unspent balance, some may not have, but no further money can be given. So that is one legal part. Legal documentation should be done, and all relationships should be formally closed with the implementing partner. Then independently, if the organization wants to implement the program directly, either the implementing partner gets the fund directly from the donor agency, or the mother NGO has a program directly at the field level. Then all these contracts, etc., should be independent contracts, whether using the staff, then staff should come through a normal recruitment process. And hiring of a implementing partner through a service contract shall be deemed as a colorable device, because the same thing which was done as a charity contract, because the law changed and it was converted into a service contract. And if your implementing partner is the only, you are the only client of the implementing partner for awarding service contract, that means normally that implementing partner is not known to those give those kind of services in the normal circumstances. So those kind of challenges will come. So as we go along, we will discuss some of the technical issues further which may arise. So I think we can leave it at this stage to that.
Thank you very much. I think that was very informative, in terms of the closure of the contract. I think this is something that needs to be seriously taken note of. But I would like to, again, bring in Dr. Patra once and ask him, does it mean that the concept of mother NGO, especially with regard to, foreign funds, it ceases to exist now? The concept of mother NGO would no more be valid as far as foreign funds are concerned in India. What is your take, Dr. Patra?
Yeah, see, we cannot tinker with the law, because the law has changed, like Dr. Fogla said, and we have to live with it, whether it's bad or good. And we have to comply with whatever is the law. And the law, the intent behind this amendment is direct implementation and not onward granting or re-granting. So as far as possible, we have to follow the law and have direct implementations, make direct implementation as one NGO, because working with other NGOs in some indirect capacity, management would also attract different implications, which we are going to probably discuss as we go along. So that will be my on this.
Right. Thank you very much. Dr. Fogla, you talked about briefly about administrative expenses. What I would like to ask you, for the benefit of the audience here, is that what is the kind of arbitrariness you see in the way in the manner the administrative expenditure is defined in the Rule 5? Where does the arbitrariness lie? Very quickly.
No, now the first arbitrariness is that regulating the admin part of expenses. Normally, admin expenses are regulated by the donor. So the donor decides that what is the amount which could be spent on admin. The second part, when you talk admin, you should understand that admin is also an expenditure applied towards the program. At best, it can be said that it's the program delivery expenses, the expenses which are required to deliver the program. So nothing can be delivered, nothing can be delivered without there is a component for taking that to the beneficiary or that particular destination. So then under all other law, under income tax law, etc., there is nothing called an admin expenses. It is whether it is applied towards charitable or religious purposes, or it is not applied towards charitable or religious purposes. Once it is applied towards charitable or religious purposes, then it is the prerogative of the donor and the organization to decide what is a fair amount. And even in the commercial laws also, it has been held by Supreme Court, High Court. There are so many cases where it has been held that what is reasonable and what is appropriate, what should be the reasonable expenditure, what should be a reasonable salary. All these are the decisions should be left to the private parties whose money is being used. So the donor and the donee and the other stakeholders, they should decide. So in that sense, that concept itself is arbitrary, saying that admin expenses which is not related to program, which is not related to program delivery, for instance, fundraising expenses, example, expenditure which are in the nature of establishment expenditure. For instance, an organization would have some expenditure even if there are no projects. So fundraising expenditure, establishment expenditure, these are the expenditures which can be said that these are not related with delivery of a program. So
Right.
these are the expenditure one may talk about, that you brought money into India, but you are actually not using it for the program. When you brought money into India and you are using it for the program, then the concept that I will not allow you this percent, that itself is an absurd concept. Now, the second arbitrariness is that the law itself says that I will treat many expenditure which are related to the program, but unless they are directly implemented to the program. But what is direct implementation? Under FC, if you see section 11 of FCRA, it says that you can receive foreign funds for a religious, for a scientific, for a cultural, for educational, social, and economic program. So for a religious activity, what is the field? What is the direct field? Or a scientific program, what is the direct field? So the understanding that it should be a welfare program and direct implementation, that itself is flawed, because the act says, because this is a rule, that act allows the money for these 6 purposes, and 4 of these 6 purposes don't have a field. You don't need to go to a village for a scientific program. What is the meaning of welfare? So now, there is, this word has not been defined anywhere, this welfare word used in the rule, because welfare means applied for charitable or religious purposes. That is the welfare, because it cannot be anything else. So the way the rule has been drafted, it creates a problem and avenues of judgmental decisions. So you have a particular designation. You call a person that this person is program manager, then suddenly subclause 2 of the rule says that program management expenditures are admin. So why program management admission are admin? No explanatory statement has been given. There is only one explanatory statement which is available. It is the parliamentary proceedings. When 2010 Act was passed, things were different. One question was asked that why the administrative expenditure limit has been kept so high at 50%. Then the response from FCRA department in those days was that it could result in harassment. It could result in harassment because many organizations, like research organizations, they may have a very high component of salaries and other expenditure which could be perceived as admin expenses. So therefore, because there is an overlap, and liberal limit of 50% is required. So there is an admission that admin includes program. So if a program expenditure is artificially determined as admin, then one has to be question the arbitrariness first. Secondly, if you see the act and the rule, section 8 of the act, which is about administrative expenses, it says that as far as possible, admin expenditure should be kept within 20%. So use of the word as far as possible itself shows the wisdom and the apprehension of the lawmakers that administrative expenditure, this section may cause problem, and this section was drafted when the limit was 50%. While drafting a limit of 15%, the lawmakers were so afraid and they wrote as far as possible. And the same rule, same section, just changing 50 to 20%, it goes against the spirit in which this amendment has come, and it is like using iron hand without understanding the realities, and there is no reasonable mechanism under which an approval could be taken, and how this administrative expenditure will be used, whether it will be treated as a compoundable offense, whether it can be an offense for which renewal can be denied. To my understanding, administrative expenditure lapse cannot be a reason for non-renewal. For example, under Income Tax Act, if there are some violations relating to say investment or benefit to interested person, those are violations where tax will be paid, but they cannot be a reason for cancellation. The same should apply for administrative expenditure. Even if there is some excess of administrative expenditure, that cannot be a reason for non-renewal, because under all other laws it is so, because and it at best it could be a compoundable offense, but that clarity is not there, and nobody knows whether a finding which is not vetted by. Today you look at a scenario, suppose an organization just before renewal there is an audit, and the audit team of FCRA department says that your administrative expenditure is 22%. So for those 2% of additional expenditure spent genuinely for the activities, your FCRA may not be renewed. So if you dispute that 2%, before you win or lose a case before an appellate authority, your FCRA may not be renewed. So that is, I think, not as per the constitutional provisions, and it is in that sense an arbitrary and unjust provision. So these kind of legal clarity regarding the consequences, the penal actions, because these kind of offences under income tax and other laws are subject to small pecuniary penalties. But that lack of clarity and any violation of the act can result in non-renewal, and those kind of things, and lack of clarity in those regard is the real arbitrariness, and it is causing the apprehension and legitimate apprehensions in the NGO sector.
Thank you, Dr. Fogla and Dr. Patra, for bringing in these larger issues, larger perspective, and technically analyzing without mincing words as to how the whole FCRA acts, the arbitrary, definitely in some areas where there is a overreach happening, and the resulting impact on the organization. So thank you so much for bringing that larger perspective. Now I would like to move into the next segment of this webinar, wherein we are going to look at specifically on the changes that have come in the rules and the forms due to these amendments. To begin with, we will start with the changes pertaining to the issues of registration, prior permission, and renewal. So what are the changes that has come in these three areas is what we're going to look at next. And for that, I would like to invite Mr. Suresh Kejriwal to give a presentation on the changes that has happened, which will be followed by a plenary discussion. Over to Mr. Suresh Kejriwal. Sureshji.
Good afternoon to all from city of Kolkata. Thanks Sandeep ji for inviting me. Thanks Sanjay ji and Manoj ji for setting the tone for today's discussion. Through this presentation, I shall mainly dealing with the amendments made in FCRA rules, dealing with registration, prior permission, and renewals. Before I start my presentation, it is to be noted that FCRA rules are equally important, as FCRA Act provides the compliances both with the Act and the rules. Even for Section 16 renewal, the Act is very clear that the government will going to find whether the FCRA Act and rules are being followed or not. And that's why it is very important for all of us to know what are the key changes being made in the FCRA rules. Let me share my slide. So first I will go with registration. The registration, they have now given an eligibility criteria. This criteria was always before in the form of FAQ. Now they have inserted through rules to make it more formal. Now an organization going for a FC registration must have at least 3 years old. They must have spent at least 15 lakh in last 3 years on activities for which registration is sought. Before this amendment, this limit was 10 lakh, and now it is amended to 15 lakhs. Now the rules state that existing asset in the form of land, building, vehicle can also be counted towards 15 lakh on declaration that these assets shall be used only for FC-related program and shall be vested and shall not be diverted for any other purposes till the validity of the certificate. Meaning thereby, if for this 15 lakh eligibility, we are choosing to calculate the existing asset owned by the organization, then those organizations should remain with the organization. They cannot sell it till the FCRA certificate is valid. And all these eligibility were already there in the form of FAQ, nothing new, but they have formalized it through rules. Now the second amendment is that the affidavit from all the board members and CEO has to be given. The filing fees has been raised to rupees 10,000. They have mentioned it is important to open a SBI FCRA account before submitting the application. And the second FCRA account may be opened or may not be opened. And the validity of this certificate shall be for 5 years. And if we are going to surrender the certificate, then the validity will reduce from the 5 years to the date on which the surrender request is accepted by the government. So these are the changes for the registration. Now second is the change amendments in regards to prior permission. Again, they have given a condition that the applicant organization should not be in a common governance with the donors. And they have specified the situations which shall be construed to be a common governance. And that includes that the chief functionary of the recipient person shall not be the part of the donor organization. 75% of the office bearer or member of the governing body of the applicant shall not be the members and employees of the foreign donor agencies. In case of a foreign donor being a single individual, then individual shall not be the chief functionary of this organization. So these are some of the common governance that should be avoided, that are prohibited once the prior permission application is being looked into. Second, the affidavit from all the board members and CEO has to be furnished. The fees has been increased to 5,000. Again, SBI FCRA account has to be opened at the time of submitting application. Now they have given a separate, inserted a separate section 9A for prior permission of over 1 crore. Earlier, for prior permission of over 50 lakhs, they have put a condition that the organization has to be 3 years old. But now that condition has replaced, and they have inserted a section that for prior permission of over 1 crore, and the condition is that for such approval, the government will approve in such installment based upon permission based installment. That suppose you are going for a prior approval for 1.5 crore, the government at the time of approval will fix up the installment. That will be 3 installment, it will be 4 installment, like that. And the second and subsequent installments shall be released or can be usable when the 75% of the previous installment is spent, it is reported, and it has to be subject to field verification. Now there is no form being given for how this report to be given. We understand it can be given in a plain paper through email, but this will defeat the whole purpose of prior permission of over 1 crore, because once you submit your report, The government is going to do the field verification. This process will take time, and the program cannot suffer, cannot based upon the permission granted. And so I understand the prior permission of over 1 crore rupees may not be of practical use. Now the changes in relation to renewal. Now we have to apply within last 6 months before expiry. Meaning, if our certificate is going to be valid till 31st October 2021, we have to apply after 30th April 21, but before 31st October 21. That means last 6 months we have to apply for renewal. The fees has increased to ₹5,000. Again, the rules are very clear. The SBI account has to be opened before we submit our application. In case the renewal application has already been submitted, the rules provide those NGOs to open SBI account and to report to the FCRA authorities, then only their FC application being submitted shall be considered. Now, already there is an amendment under section 16 that the inquiry for compliances in line with 12.4 shall be done before granting the renewal. Now, the rule 5 provides that the FCRA registration ceases on the date of expiry and no further receipt or utilization after the date of expiry. Before amendment, even after the date of expiry, if your application has not been considered, the NGO is not supposed, cannot receive fresh foreign fund, but they are authorized to use the unspent balance lying with them. But now the amended rule says on the date of expiry, if your FCRA registration has not been renewed, no further receipt and also no further utilization. That means all program activities will come to a standstill, funded by foreign fund. Again, they have inserted a section, deeming section 12.6 and 12.6a. They are saying if no application is made or application is not accompanied with fees, the registration shall be deemed to have been ceased. That means if we are not submitting our application within 31st October, or if we have submitted the application but without the fees, our registration shall be deemed to have been ceased. And if in this deeming section, all FC and even the FCRA asset shall vest with the government till the FCRA is renewed or registered again. So again, the Act is Act is silent on the vesting of asset. They have recently amended and brought in the surrender of FCRA registration. The renewal issues was the same, but through rule by inserting the deeming provisions, the government intend in case the application is not being submitted or the organization choose not to submit renewal application, then their FC and FCRA asset shall vest with the government. Now the key changes in the FC forms in relation to application for registration, prior permission and renewal. The furnishing of Aadhaar number made mandatory for all from optional. Details of bank account, FC bank account we have to give. The amended application form requires specified information for all the office bearers and key functionaries instead of only key functionaries alone. That is whether the concerned member is convicted or prosecuted, whether the concerned member is found guilty of diversion of fund of association or any association in the past, whether he is the current key functionary of any other association or association against whom order under section 13 and 14 has been passed, etc. So earlier, this information was sought only for the key functionaries. Now, at the time of submitting your application for registration, permission and renewal application, this information has to be submitted for all the office bearers. Now, for surrendering of FCRA registration already amended by inserting section 14A, the NGO can surrender their FC registration if not needed. But this year, this amended rules, they have inserted form number FC7 to make such application. The department will conduct inquiry before accepting, and all unused FC and FC asset will vest with the government. And the surrender shall be effective only when the government approves it. Now the rules have also changed who shall be the custodian of FC in the case of cancellation of certificate. And as per the amended rules, the vesting shall be with the prescribed authority as is specified under the Act in place of the bank. But again, they are not including section 14A surrender in the custodian of cancellation of certificate. And lastly, There are key amendments in relation to notifying an organization to be of political nature. The Rule 3 of FCRA rules specified the guidelines summarizing the grounds on which the organization can be declared as organization of a political nature. FCRA Amended rules has amended this guideline and provided that the community organization like farmers, workers, students, etc., and any organization which implies common method of political action like Bandh or Hartal in support of public causes, not to be treated as organization of political nature unless they involve in active politics or party politics. So these are the few changes in relation to amendment, in relation to registration, prior permission, renewal, and the process of notifying an organization to be of political nature. Now over to Sandeep.
Thank you. Thank you, Suresh, for providing that clarity with regard to the changes that has happened pertaining to registration, prior permission, renewal. Now I would like to invite other panelists also for a quick discussion on some of the issues emerging out of these changes that has come. First, I would like to ask Suresh directly to you, is that you said for a registration or a prior permission, you need to open a bank account. Now, does an organization need to open a bank account only in SBI branch, or the another FC keeping and utilization account also needs to be opened?
The FCRA rules are very clear. They are saying SBI account is a must. And second FCRA account used for keeping and utilizing, they can open or they may not open. They choose not to open at the time of application. So the second FCRA account is an option, but first SBI account is a must.
Right. So that's the optional part. The second one. The bank is compulsory. Now, you also talked about this threshold, and I would like to ask Dr. Fogla here that, in order to cross the threshold of 15 lakhs when you're vesting, it is said that the assets capital investment would be treated as part of the FC for the FC purposes till the registration is valid. Now, will this also constitute as part of FC assets, let's say at the time of surrendering of your FCRA registration or cancellation of your FCRA registration, and therefore these assets also would be vested in the hands of the government?
No. On reading of the form and the rules thereof, it is very clear that it is an eligibility criteria. Government has given an additional privilege that even if the organization has not been able to spend 15 lakh, they may still apply for the prior permission registration by setting aside certain assets. So these assets, to our understanding, because they are of local money, they will always remain local assets, but they cannot be used. They cannot be used. They will be available only for FCRA, and these assets cannot be sold or divested till the FCRA registration is there. So I don't think at the end, if there is a cancellation or a vesting of asset, these assets will be included. But it is important that these assets are kept in the local books, and an appropriate accounting and audit note regarding the vesting of these assets based on the declaration given to the department is maintained, because this issue may be a long-term issue. You vest it today, and after 20 years, 10 years, this issue will be relevant. So, and continuous recognition of this fact that these assets are restricted for FCRA purposes, but existing in local books, that clarity should be brought in the audited statement, and the chartered accountant also should maybe put a comment in the audit report to that effect.
Right. Since we are talking about vesting of assets, I would like to ask you also about this issue of the validity of the FCRA registration certificate. Now, 12.5, as Suresh was mentioning, it says that if your registration validity ceases, then you are not permitted to receive or utilize foreign funds. And then 12.6a and 12.6b talks about the conditions under which your registration application for renewal will not be considered valid. Now, in this context, what does it mean if an organization applies for a renewal, and that is put on hold? And we have seen in our experience earlier that FCRA department sometimes takes a year to revert back on some of the applications. Hundreds of organization applications were put on hold. Neither they were rejected nor they were accepted, but they were simply put on hold. Now, in conditions like that, do you think that those organizations can utilize the existing FC fund, if not receive further foreign funds from abroad. What do you think, Dr.?
But the way the new rules have been amended, and all certificates are time-bound certificates. So whether there is an additional process is being done as per the procedure or there is a delay, it is an independent issue. But the certificates are going to lapse. The certificates are going to lapse on that date. Most of the certificates, I think, are going to lapse, I think, either 31st or 1st October 2021. So that is the day, irrespective of the other processes. For instance, the tenure of your certificate is an independent legal reality, an independent legal fact. And renewal is a futuristic issue. So renewal is not related with your existing certificate. So if your existing certificate expires, and then I don't think under the new rule, earlier there was no bar on utilizing the funds, but in the new rule, I think it will be deemed with on par with non-renewal and other processes. So an organization should apply the certificate, maybe gives at least 6 months time to the FCRA department and get it renewed. Otherwise, when that prior to the expiry of the certificate, the matter should be taken up with FCRA department, and an organization may look for legal options also. But I don't think they can continue as an FCRA organization after the expiry period.
So this is also related to this vesting of asset. Now, in such case, do you think the assets, FC assets and FC fund would also get vested if there is no response from the FCRA department? And you know by experience that the response doesn't come on time, but let's say the registration validity is already over.
No. One is that vesting, and other is that the prescribed authority taking control of the assets. So technically, the way the new rules have been drafted, in the rules, even the non-surrender circumstances, surrender, cancellation, all circumstances have been covered. So this particular circumstances, delay, and this aspect is not specifically provided in the rule, but I think in the larger interpretation of the law, whatever is the status to all other circumstances where you are not renewed, you are cancelled, you have surrendered, the same norm will apply. How effective will be the vesting process, whether the vesting authority will be proactive. Normally it has been seen even in cases of cancellation and other things, the FCRA department in the past, the vesting authority has not taken control over the assets. So how effective and how it will be implemented, that is not known, but the same norm will apply to such circumstances.
Right. In the context of this applying for renewal, Dr. Patra, it says that you need to apply within 6 months of the date of expiry. Now, if you don't apply within 6 months, is there a provision for delayed application? It used to be there earlier. Has that same provision been retained? What is the issue around this? Because it says that once your validity is over, you cannot receive or utilize FC funds. Then what is the point of having this delayed application in the Act?
Yeah, that's a good question, because there is no change in that. So one can file an application later on also, but the application, the registration will lapse in any case on 31st October, and all the related provisions would apply in that sense. Yeah.
Right. So, but there is a provision for delayed application.
Yes. Can I add Sandeep here?
Yes, please go ahead.
Actually, if you are allowed to, if you are filing the delayed application, at least if the renewal is granted, then the vesting of asset will be returned back to the organization. So by submitting the delayed application, your registration on granting the renewal application, your asset can be revested to you. Otherwise, you have to go for the registration process once again. So even if on delayed application there is a vesting of vesting of asset or non-using of the FC fund, but this will definitely help. And second point I am making is the point of application now extended within the last 6 months, and the department saying they will take 3 months to process. So I advise, if you are filing your application in October, then you are not going to receive your renewal. At least file 3 months before, so that we can have a case to fight if the renewal is not granted within 90 days and the funds are not liable to be used. So at least you submit your application, give 90 days sufficient time within the validity period to the government.
Right.
That's a good clarity. I think we would rather say, out of abundant caution, do it in 180 days before. I mean,
That's right. That's right. As soon as
wait
possible.
for, because the assets will be.
Yes, that's a clear piece of advice. Don't wait for the last moment. Do it as early as you can, which is after 30th April that you can apply for renewal. Now, which is also, one issue related to that, Mr. Kejriwal. Now, let us assume that the renewal application was made within 6 months, but it was rejected. Before, let's say the validity is till 31st October, you make an application in, let's say, May. In June, you get a rejection, your registration is not renewed. In such cases, can the organization use their existing FC funds or for that matter, even receive foreign funds, given the fact that their FCRA registration is anyways valid till 31st October? It was not renewed beyond October, but it is valid till 31st October. So can they do that?
Actually, you're meaning that if you made the application for renewal well in time, and our renewal has been refused before 31st of October, and at that time the registration was valid. To my understanding, the renewal of registration certificate is from 1st of November, supposed to be from 1st of November, not before, and so cancellation is also from 1st of November. So the NGO in those situations can receive new foreign fund up to 31st of October and can also utilize this cancellation or refusal of applications shall have an impact only from the 1st of November, that is once the date of expiry of the original certificate expires. It has nothing to do with the date of cancellation. Right, however, if the date of cancellation is after the date of expiry, then all the consequences will follow.
Right. So one very quick question on this, the aspect of prior permission, Dr. Fogla. It says that if the prior permission amount is more than 1 crore, in such case it will be paid in installments, and second installment will only come when 75% is utilized and you have reported, and there is a field inquiry from the FCRA department. How does this whole reporting mechanism work? Is there a format prescribed as to how this reporting will happen?
No, though the existing form, which I don't think there is a special form for reporting the separate 1 crore. I think we have to wait, because this is a new rule. Whenever a new prior permission will be accorded, so then with that prior permission approval letter, I think these norms will be given specifically to that particular party, because this is a general prior permission are generally case-to-case issues, and maybe the FCRA department now wants to monitor prior permission on case-to-case basis, and it is not a generic thing. And in a prior permission, in any case, the organization doesn't have a general registration of the organization. So I think we have to wait once these rules are implemented and new prior permissions letters come, and in those letters we may find the procedure and the reporting thereof.
In fact, just to add, even before the rules were amended, there were certain prior permissions in which this was already coming. It was already there, and the installments were defined in the prior permission registration letters that used to come. So in any case, it was already being practiced, even though it was not enacted. So now that it is part of the enactment, so probably they are also trying to make it much more valid and legal.
Right. So any other point any of the panelists would like to make on this aspect of registration, prior permission renewal? If you would like to add anything on this aspect, if not, then we will move into the next segment. It is getting very interesting. A lot of issues are being discussed and debated and clarified, and I am hoping that the participants are really getting benefit out of this webinar. Please continue to post your queries in the chat box and not the question and answer box. I have been saying since the beginning. because we are compiling these questions which will be taken up later after this whole presentation and panel discussion is over. Now we will move into the next segment of this presentation, which would be on the issue of bank account and admin cost. And once again, I would like to invite Mr. Suresh Kejriwal to please come and tell us what are the changes that has happened, and what are the critical issues emerging out of it. Over to Mr. Kejriwal.
Thank you, Sandeep. Now I shall deal upon with the key amendments in relation to SBI bank account, or say bank account, and the administrative expenses. The opening and approval of the SBI bank account. We all know Section 17 has been amended, making it mandatory to open a SBI account, New Delhi main branch, by all the NGO, irrespective of their location. And they can receive foreign fund from only that account. Now, the existing FCRA registered NGOs and NGOs having prior permission are allowed to open new FCRA account with the State Bank of India latest by 31st of March 2021. And up to that time, until the time the bank account with SBI is opened, the existing designated bank account can be used. However, once the new account with SBI is opened, the FC fund can be received only through SBI. Now the SOP is uploaded by the ministry website on 20th of November, and it mentions that the State Bank New Delhi main branch will allow receipt of FC after confirming that MHA has already granted a certificate or prior permission to the NGO. An entity can maintain existing designated bank account as another FCRA account for keeping and utilizing. That means SOP of the website, SOP is uploaded by the ministry in their website, clearly allows the bank to allow the credit of the FC money once they confirm that the MHA has already granted a certificate of registration to the NGO or to the applicant or to the account holder. But even after opening the FCRA account, SBI is not allowing credit till the bank account is approved by the ministry. At the same time, after opening up the SBI account, they are not able to receive the fund in their existing designated bank account. And that becomes a very, very critical situation for them. The intimation for opening the SBI account to be given in form number FC6C. And as per SOP, existing designated bank account can be maintained as second FCRA account, but no formalities have been specified for such repurposing, because existing designated bank account was only for receiving and utilizing. Now the purpose is changed to keeping and utilizing, but the new law has not given any specific formalities to be complied with for such repurposing. Now, new FC4 form have self-compliance declaration by the NGO, 15 self-compliance declaration, and these self-compliance declaration includes self-compliance declaration for the bank account as well. One declaration is whether any domestic contribution has been created in FCRA account. That means at the time of submitting your FCRA application, FCRA return, you have to submit whether any domestic contribution has been created in any FCRA account, yes or no. If you are saying yes, then you have to give the details. Second, the association has received any foreign contribution in an account other than designated FCRA receipt account, meaning all FC receipt, whether has been received through the designated FCRA receipt account or not. Now the issue is, for example, refund of income tax refund. We all know when the refund is composite, both for local fund and the FC fund, we first deposit to the local fund, and then the appropriate part will transfer to the FC fund. I think this details needs to be now furnished at the time of submitting FC4 by taking the yes column and then submitting the reason for amount and reason for such deposit. Now the FAQs, the self-declaration says whether any assets acquired out of foreign fund has been sold out and the sale proceeds of the above asset has been diverted or has not been deposited in FCRA account. So the self-declaration says whether the sale of fixed asset has been diverted or has not been deposited in FCRA account. Again, the self-declaration form is saying whether any FD proceeds have been created in account other than FCRA account. So in point number 6, they are mentioning the receipt through a designated FCRA receipt account, but for sale of assets, FD proceeds, they are using the word FCRA account. They are not using the word designated FCRA account. So it may imply that that when you are receiving foreign contribution, the foreign source, as a first recipient, it has to be through SBI. But the sale of assets or the FD interest or the FD proceeds may be deposited in FCRA account. FCRA account means both SBI account and the SBI FCRA second account. But there is no change in the law. The law says second FCRA account can only be used for keeping and utilizing. That account is not for receiving, but this self-declaration form gives the impression that the second FCRA account can be used for sale proceeds of the land and the FD proceeds. Now all these things to be bring clarity by the ministry. So these are the changes regarding bank. Now concerning amendment in relation to the administrative expenses, we all know section 8 of the FCRA has been amended, reducing the cap of admin expenses to 20%. This section also provides that the admin expenses may exceed beyond 20% with the prior approval of the central government. Rule 5 of the FCRA provides what shall include under administrative expenses. It also provides certain exclusions. In amendment rules, there is no change in the definition in section 5 of the amended FCRA rules. As per amended FCRA rules, organization has not only to report the total amount of admin expenses in FC4, but also has to declare whether admin expenses on administrative, whether expenditure on administration exceeds 20% of the FC received. If yes, details has to be given. Meaning thereby, earlier we used to only report the total quantum of admin expenses. Now we have to also declare whether that expenditure exceeds 20% limit or not. Hence, it is very important to understand what shall be included and what shall be excluded as admin cost under Rule 5. And at the same time, it is very important that our financial report, audited financial report, submitted with the FCRA department, the total amount of admin expenses calculated following Rule 5 should be reported either separately in the financial statement or it should form part of a notes to account, so that there is a clarity what are the admin expenses as certified by the auditors. Now, what can be included as per Rule 5? The inclusion is remuneration or reimbursement of other expenses paid to members of the governing body, expenses on person for managing of the activities including cost of travel, expenses like electricity, telephone, postal charges, repairs, printing and stationery, cost of accounting and for administrative fund, expenses towards running and maintenance of vehicle, cost of writing and filing reports, legal and professional charges, and rent of premises, repairs of premises, and expenses on other utilities. So there are 8 listed heads which shall be included under admin cost. Now you find point number 1 is functional, relates to the governing body. It is very easy to identify. Point number 3, point number 4, it is the cost of accounting and admin cost, again relates to functional. So whenever there is a functional relation to the heads, it is very, very easy to know how to calculate the admin cost. But the cost of writing and filing reports, cost of maintenance of vehicle, they are not linked to a functional classification, whether the program or whether admin. And that leaves a room for speculation whether all vehicle cost will come to the admin cost or whether only the program will come under admin cost. Again, point number 2, expense on person for management of the activities. The word used is the management of the activities, not all the staff. So one argument may be management will not include the staff who are engaged in implementation of the activity. So the rule specifies 8 heads or type of expenses that shall be treated as admin expenses. However, the above listed expenses should be reviewed in context of exclusion as provided in proviso to Rule 5. And the admin expenditure as per Rule 5 doesn't include capital expenditure, and this is also getting clarified through FC4 reporting. So now it is very important to know what are the exclusion for under admin cost. The first exclusion is salary and remuneration of person engaged in training or analysis of data of an association engaged in research or training. That means if an organization engaged in research and training, then their expenditure incurred on salary and remuneration of person engaged in training and only analysis of field data are excluded to be admin expenses. And second exclusion is expenses incurred directly in furtherance of the stated objectives of the welfare-oriented organization. Now, what is welfare-oriented organization is not defined in the Act. Dr. Fogla has also dealt upon these issues during his preliminary discussion. Now, if one have to define what can be the welfare-oriented organization, the one of perception may be if the program is directly for the benefit of beneficiaries with direct interface with them. However, whether the organization engaged in promoting of environment or Swachh Bharat mission shall be covered under welfare-oriented or not is an issue which needs to be debated. And again, how the expenses incurred directly in furtherance of the stated objectives to be identified is again of subjective issues. As per my understanding, we can have some yardstick to determine this. For example, if the staffs are engaged and they have an interface with the beneficiaries, then they can be said to be they are directly in the furtherance of the stated objectives. Similarly, if the assets are used for the beneficiaries, training equipments, if we are incurring any expenditure or maintenance of those equipments, it can be said that they are directly in the furtherance of stated objectives. So basically, we have to see the interface of the expenses with the beneficiaries, and then we can define what can be the directly in furtherance of the stated objectives. But this is my perception. This is a subjective issues, and this perception may vary from person to person. So this is all regarding admin expenses. Now over to Sandeep.
Thank you, Mr. Kejriwal. I think once again, it was very informative, and you nicely highlighted different changes that has come. I would like to bring in Dr. Patra here, and for the benefit of all the audience, benefit of all the participants, even though now it is quite well known as to how it should be, but if you can tell us what is the procedure for opening this bank account in SBI, New Delhi branch. If you can briefly tell the procedure, what should an organization do?
So there is a SOP which has been circulated. One was circulated by the State Bank of India. Later on, it was tweaked and was released by the department. Now, as we understand that the procedures for an opening of a normal bank account are given, but there is a KYC requirement which has to be done by the board members or trustees. And the bank says that can be done from the respective places that the trustees are in. They don't need to come to Delhi. Nobody needs to come to Delhi. They can do it from their own respective branches of the State Bank of India based on that SOP. How easy it will be, how difficult it will be, time will only tell. What we have understood is that out of 23 or 24,000 organizations who have to open the bank account, only 200 have opened so far. Which is that there's a long way to go, and there will be a lot of towards the end of the this whole timeline. And what we have been saying is that after it is opened, the FCRA department has to give a concurrence to it, and that it will be probably to file form FC6. That is not clear yet. It's not there in the nowhere it is being prescribed, but as a practice, some organizations are filing FC6 for change of designated bank account, and the department is also giving them permission. Few permissions have been received. So that is the whole scenario as of now, but the processes of the bank has to be fulfilled, and there is a separate numbers and designated people are there in the branch.
Right. Dr. Fogla, in the amended rules, in several places, it talks about FCRA account, and it refers to section 17. What does this FCRA account constitute of? Now that there are 3 levels of bank account, if you could throw some light on that, because it has implications on other aspects also.
No. Now, as you have said, there are 3 types of FCRA account. For receipt of foreign contribution, which directly comes from foreign source, that will be SBI New Delhi. And then there is the current existing designated bank account can be the second FCRA account for receiving and not receiving, keeping and utilizing FCRA fund. Then additional utilization account. So these utilization accounts are not covered under FCRA accounts. So wherever the difference of FCRA account, it would imply the SBI account and the designated bank account. If you see form FC4 in the declaration also at 2 places, it says regarding there is a declaration which says that whether a foreign contribution was received in any account other than the or receipt of foreign contribution, that is the SBI account. Then at another place, the declaration says that whether any FC asset was sold, and whether the amount was deposited in FCRA account. It doesn't mention the SBI account. So FCRA account for all practical purposes would mean both the accounts, the designated SBI account and the other account which is used and utilizing FC money. So other than all bank accounts, other than utilization account are FCRA account.
Right. So which means that, for example, your income from FC assets, or let's say rent out of FC property, or even fixed deposit receipt out of FC funds, where do these needs to be deposited? Because this is the query that we receive regularly from different NGOs. Does it need to?
And this is quite complicated. But if you carefully see, the purpose of the FCRA law is that anything where there is a transfer involved and it comes from a direct foreign source. So there are foreign contributions, two types of foreign. One is a foreign contribution as first recipient. The other is a deemed foreign contribution as subsequent recipient. Now subsequent recipient cannot be inter-charity grant. So all subsequent recipient transaction or deemed foreign contribution will be the generation of income or direct indirect income from assets, FC assets, FC projects. Those are deemed foreign contribution. So as we understand that whatever is coming from banking channel, that should be received in the SP. But anything which is not it is a recommended practice. But anything, suppose you are earning, say, a small amount of money in cash at a village level, then probably the intent of law doesn't seem to be that particular 100 rupees or a small negligible income should be taken to New Delhi or in a multi-city branch has to be deposited. This aspect, as I told, it is more clarified when we have a look at the declaration under form FC4. One of the declaration under one FC4 says that if any asset was sold, whether the money was deposited in FCRA account, it doesn't say FCRA account for receipt of foreign contribution. Just in the one of the other declaration, it says that all this. So in that sense, it means that though the law is not clear, we should expect that the FCRA department will come out with some kind of clarification. But any cash generation or any interest in any case will be generated in each account. One more thing I should say, that FCRA law applies to delivery or donation. So these are the three words used. So when you receive something in cash, suppose you do an FCRA project and a delegate gives you 200 rupees in cash. So the transfer happens when you receive those 200 rupees. You already received FCRA money, the transfer already happened. Even if you deposit that money in the FC account, it will be a cash receipt deposited subsequently. Under the law, it will be a cash receipt, it cannot be a banking receipt. So in at the point of transfer, there are many transactions which are not practically possible to be received or the transfer to be effected in the designated FC account. So whatever transfer which can reasonably be effected directly in the SBI account may be done. Most of the banking transactions should be done in the FCI account. But if there are other receipts, etc., I think the FCRA designated account could be the account where they could be deposited. The deemed contribution for all circumstances, for all purposes, from foreign sources, first recipient, the FCRA Delhi account is the recommended account, it is a statutory account. All banking transactions where the transfer can be directly effected through banking channel, the efforts should be made to be received in the designated SBI account. Then, in line with the declaration under FC4, the money, if it is there, it can be deposited in the designated second account. So, circumstances, utilization account should be used.
Right. So I think the advice is pretty clear in terms of where the FC income can be deposited. All banking, go to SBI New Delhi first. That should be the primary bank where you should receive it. Cash related, it can go to a second FCRA account, but in no case utilize in bank account. So I think that is coming out very clearly. The advice is coming out. Mr. Kejriwal, you talked about the change of the purposing of bank account. Now your existing designated bank account becomes a second FCRA account. So for that purpose, what is the procedure? Do you need to apply online, or how do you all out? Is there any guideline?
Yeah, that is the whole point of confusion, because the FCRA amended rules have a section for FCRA first account. They have a section for classic account, but they have no section for FCRA second FCRA account. So FCRA rules have read after the existing law. So they have not inserted even for the change in the second FCRA account, what application we have to submit and what is the process. They are still maintaining on their classic bank account. Right. Okay. And secondly, the FCRA form also, the new form, FC6C, they talks about SBI account and second FCRA account. Change in second FCRA account. They are not saying the word opening of FCRA account, second FCRA account, and repurposing of existing account. So rule says opening of intimation of opening of SBI account, which is not going to be changed because it is fixed. And second says change in the second FCRA account. So for example, if an organization choose to apply for registration only with the SBI account, and after getting registration, they have opened a second FCRA account. So for them also the word change will create a problem because they have just opened the second FCRA account. So I think the rules has to be clarified regarding the approval of repurposing, regarding the approval of intimation of the opening of the first time FCRA account, second FCRA account. That I think rules have to be evolved. But till now there is no clarity on that.
Right. I think so. I think that's a bit of a confusion where there is also what is understood is that the government is trying to sort of rework on the existing website and perhaps automatically align your existing designated bank account will be automatically aligned as a second FCRA account, but that is left to be seen. I don't know how it will happen. Once organizations start making the change, we'll come to know. Well, on the aspect of admin cost, I think we've discussed quite in detail during the last webinar. Dr. Fogla talked quite in detail during his deliberation on the larger aspects of FCRA. So it has been discussed quite in detail. But just one question that I would like to ask for the benefit of the audience: now that this 20% limit is prescribed in the middle of the year, so this has come into effect from 29 September 2020. What will be the basis of calculation? Will it be 20% for the entire financial year, or what? How is it going to be, Dr. Fogla, for reporting purposes?
No. The issue is that the forms and the reporting formats have not been changed. So ideally, there should have been a division up to 28th of September, and then from 29th of September, the remaining period up to 31st March. So evidently, the limit available till the enactment of FCRA Act is 50%. So up to the practically first 6 months it is 50%. The remaining 6 months is 20%. So there is no confusion about that. But the FC4 for this particular year, as of now, as we understand, doesn't give that want that bifurcation. But the organization should ideally bifurcate. Organization should ideally bifurcate, and 50% and 20% will be available. Reporting annually should be made accordingly. 20%, 50%. And in that case, maybe some offset would also be available. Not that the offset is recommended, remains that way. Remains that way. Then the utilization for first 6 months 50%, and utilization for next 6 months 20%. That is how it will be calculated. On the plain reading of the statement or the form, one will not know what exactly is the percentage of admin. and whether it is compliant with the law or not. Maybe an organization should prepare additional accounting notes, and maybe the division should be provided, even though it is not there in the form. 20% after enactment, 50% before enactment. That is the law.
Right. Thank you very much. So last question on this administrative issue, because I'm also conscious of the time that we are overshooting in some sense. Now in this Rule 5, Dr. Patra, 2 exclusion provisions are provided. One is with regard to research and training organization. The other is with regard to welfare-oriented organization. How do you define what is a welfare-oriented organization? Dr. Fogla briefly touched upon this issue already during the deliberation, but if you could throw some light on this aspect, what is a welfare-oriented organization?
I think, you see, there are these 5 purposes, but then this whole welfare thing comes in the rules. So there is that confusion is there, that what is, for example, you receive FCRA registration for these 5 religious, social, economic, educational, cultural. There is no welfare thing mentioned. And then when it comes to application of administrative expenses, then there is a word welfare oriented comes. So I think understanding of welfare would be that hardware activities on the ground. Those who are implementing programs directly on the ground with the beneficiaries, would providing them with relief and rehabilitation, if it is a relief rehabilitation kind of organization, or development work directly on the ground. Those kind of organizations or those kind of activities would constitute a welfare activity. If there are intermediary activities happening, then I don't think it will consider a direct welfare activity. So that is the conclusion we need to take.
Right. So there is obviously there is no clarity, because it has not been defined anywhere in the rule or the act. When the purpose is something else, then in the rule they say welfare-oriented. But I think that's a piece of advice what Dr. Patra gives from his long years of experience of working in the development sector. Now we will move into the next segment, which is extremely crucial and critical one, which is with regard to declaration, reporting, and intimation. And now I would like to invite Mr. Suresh Kejriwal to please come and present the last segment of this presentation.
Thank you, Sandeep-ji. Let me begin my presentation. So in this session, we shall discuss the key amendments effective from 10th November on declaration, reporting, and intimation. So the amendment in reporting requirement, basically amendments are made in the written, this is FC4. There is no amendment for declaration, quarterly and yearly declaration, that remains the same. Only there is amendment in FC4. Then there is amendment in intimation for change, 17As. When we have to intimate changes for name and address, we have to intimate changes for nature, aims, and objective. We have to intimate changes in the daily bank account. We have to intimate the opening of the class bank account, and we have to intimate change in the keyboard members. So now, as per the amended rules, all these intimations shall be effective, though the rules started with intimation within 15 days. But the proviso has been added saying all this will be effective only on the approval of central government. So all these changes, change in the name and address, change the nature, aims, and objective, change in the bank account, change in the class and account, even change in the class and account mandate, and change in the keyboard members shall be effective only after the approval of central government. So now, once we are opening the class and bank account and we started using it, now after this amendment, this will be a problem. Again, some may argue that change in the keyboard member, how the FCRA department can take the process of approving those changes. My understanding or my perception can be that initially this change was reported on the board members. At that time, the board members were not supposed to give an affidavit. Now, every appointment, every new board member has to give an affidavit, and through this they are undertaking their responsibilities. I think what the government is intending by prior approval of the approval of the intimation is that those affidavits has to be now changed to another board member, and that's why they are calling it for a prior approval. For example, from a bank, if somebody has taken a loan on a personal guarantee of a director, if the director changes, the bank does not relieve him from the personal guarantee. For that, that is a separate process. I think the FCRA department may be looking from that angle for approval of the board members. Now, any change in the board member has to be intimated instead of 50% earlier. And form number 6A earlier used to intimate for a change in the address within the same state. Now, change anywhere can be intimated and can be approved by the ministry through filing up 6A form only. Now, the summary of amendments in forms. The forms are specified to submit application, intimation, and returns. The amended rules effective from 10th November has modified all the forms FC1 to FC6, including FC4. FC5, the form for application for seeking permission for transfer of FC to unregistered person has been deleted. Form number FC7 has been inserted for application for surrender of certificate of registration. In all the amended forms, the word association has been replaced with the word person/association. This amendment was overdue because the definition of the person has inserted through FCRA 2010, but the form continues to have only association. But now they have inserted the word person/association in place of association. Still, why they continue with association is not very clear. Now, the uploading of form has been amended to be in electronic form in place of uploading electronically online. And lastly, as per the amended rules, application for compounding to also be in the electronic form, but the form has not yet been prescribed. The review petition can be on the plain paper still after the amended rules, but the compounding application is amended to be in the electronic form, but the rules are not yet prescribed as per the rules appended with the amended rules. So these are the broad overview of the summary of the changes in the form. Now, the very, very key important, the key changes in the FCA4. The key changes in FC4 already effective from 10th of November 2020. The amended form has already been uploaded, meaning thereby, even for financial year 1920, that means before 29/9/20, the last financial year, one have to use the new uploaded form. And I had the occasion to visit to the ministry portal, and I find this FC4 uploaded by the ministry is neither the previous one and nor the amended one. Because the foreign contribution from the local source was deleted because of section 7 deletion in the amended form, but that clause is still there in the uploaded FC4 form. But all the 15 declarations have been embedded in the FC4 return for 1920 as well. Meaning thereby, though the 50% limit was there, but they have to compliance report, they have to furnish whether admin expenses exceed beyond 20%. If yes, they have to give details. For transfer to other organization, they are mentioning the date as 29/9/2019 instead of 20. And again, that is not applicable for last year. So this amendment made midway, and that made effective also for the last year pending returns, will create a lot of difficulty for the NGO to submit their return. Now, all the receipts should be summarized into social, culture, education, economic, and religious. The table in point number 3A shall include capital expenses, but shall not include amount transferred to other organization. And clause 8 has been inserted asking declaration from the reporting NGO by taking yes or no on 15 compliances issues under FCRA. It is also provided wherever the answer is yes, the organization has to provide the details. And through the public notice dated 23rd of November 2020 in relation to FC4, the FC4 return for the financial year 1920, the timeline has been extended to 30th June 2021 from 30th December 2020. This is a welcome move to extend the timeline, but that public notice gives the reason for extending, and while giving the reason, they are mentioning that the NGO was required to open an account with SBI, they are required to open the Aadhaar details of the board members, they are required to give the affidavits, and they are required to obtain the Darpan ID. I don't think all these 4 conditions applies to submission of FC4, but by including the public notice, I don't know whether they're going to change the FC4 form already and upload it to the ministry website, or whether the obtaining the Darpan ID is going to be compulsory, because the public notice gives a hint in that respect. Now, briefly we'll talk about the compliances, the reporting compliances, 15 issues. It is very, very important for us to understand. The certain compliances declaration are in terms of section 5, when they are saying whether any foreign contribution was transferred to any other FCRA registered association. That means reporting entity has to say whether during that year any FC contribution was transferred to any FC registered association. Second declaration, any FC was transferred to any non-FC registered association. Thirdly, any organization or entity not belonging to the association is being managed or financially supported by association. Now they have used the word whether the reporting entity is managing any other association or not. What is the term managed is not very clear. To my understanding, in some of the cases, there is a project governance team separate involving the donor, involving the mother NGO. I think if those situations are there, then they will be caught in this declaration. So these three declarations in terms of section 7, then they are asking for the compliance declaration in terms of section 12.4. When they are saying whether any functionary of the association has been prosecuted or convicted under the law of the land, the association or any of the functionary has violated any of the condition as enumerated under section 12.4. That means the 12.4 was a verification conditions by the department. Now every year while submitting the FC4, every reporting entity has to reconfirm that they are complying with 12.4. Now their compliance declaration in terms of section 8, and it says the association has utilized foreign contribution for any purpose other than defined purpose in the FCRA certificate of registration. Very, very important. If your FCRA certificate is for social and if you are using it for education purpose, you have to report it. The association has invested any foreign contribution in any speculative activity as defined in Rule 4 of the FCRA Rules 2011. And the association has made expenditure on administrative expenses exceeding 20% of the foreign contribution received. Now, other declaration. Any asset created out of foreign contribution is registered in the name other than name of the association. Earlier, this requirement was through an FAQ on the declaration that all the assets must be in the name of the organization. Now, as a reporting condition, as a reporting declaration, they are taking a declaration that all the FC assets are in the name of the organization. Maybe they are clearing their way. The asset can, at the time of vesting, this name issue doesn't emerge. And lastly, the declaration says the association has utilized any foreign contribution outside India. That means the reporting entity, if they have incurred anything outside India, they have to report as a separate declaration while submitting the FC4. So these are, and the declaration in relation to the bank account, I have already covered 5 declarations in my previous presentation. So these were the 15 reporting declaration, compliance declaration, which one reporting entity has to give while submitting their FC4. And this is in brief the amendment made in relation to the reporting. Over to Sandeep.
Thank you very much, Sureshji. Extremely informative. Let me get on straight to the declaration part, and this is the absolutely new thing that has happened. Many of these declarations are new, which is not there, and these declarations are going to have crucial impact, crucial effect on the organization. So let me bring in Dr. Fogla straight away here and ask him this declaration number 2, Dr. Fogla, out of this 15 declaration, says any foreign contribution was transferred to any non-FCRA registered association. Does it also include commercial transactions? Do you need to declare commercial transactions because it says non-FCRA registered organization and it says transfer of FC contribution?
Because this transfer related issues are there. Before answering that, let me just share one more case. There was a case in Karnataka High Court where an organization, because prior to 30th September, inter-charity grant was permissible. An organization transferred FCRA grant to non-registered organizations, the organizations which did not have FCRA. And based on those, the actions against that organization was taken under FCRA as well as the Income Tax Act, and the Income Tax Act, the 12 registration was also cancelled. So in this case, it was decided that giving inter-charity donation to an unregistered organization in itself is not a violation. It in itself is not a violation which requires withdrawal of registration. The procedural violation, and a department may do inquiry, and accordingly they may fix up whatever liability, whether it is compounding of offense or under income tax, it is applied for purposes other than charitable purposes, and whatever the law will apply, whatever the taxes etc. will apply, that will apply. But it is not a violation serious enough. The court went on to say, in one case Supreme Court has also said that giving to unregistered organization in itself is not an illegal activity. It may not be complying with a particular provision, but it is not an illegal activity. But now coming under FCRA, this norm now is not relevant in the sense that any kind of inter-charity grant to registered organization or unregistered organization is considered as a violation of the Act. Now, some organizations are saying that whether they can give a commercial contract to a charitable institution. As I said earlier, that giving a commercial contract to charitable institution, one, the language of this declaration says whether any foreign contribution was transferred to a registered organization to an unregistered organization. Foreign contribution, if one literal meaning is that the balance available with the organization is the foreign contribution. Any kind of transfer, whether commercial or non-commercial, could be the first interpretation out whether foreign contribution was transferred. So foreign contribution in hand, because an organization has domestic contribution, an organization has foreign contribution. So any kind of transfer, and it is a declaration. It is not that it is not permissible. For instance, under Income Tax Act, we give salary to functionaries. Those are permissible, but still you have to make a declaration. So that is one interpretation. The other interpretation, if we take it, that the intent could be that whether some foreign contribution was given as foreign contribution. That means foreign contribution was given as a grant to a organization, which could be a possible intent of asking this. So even in those circumstances, one should be extremely careful about giving a commercial contract, because I remember the words of the Joint Secretary. One of the, nowadays we don't see the FCRA department engaging with the civil society, but in 2010-11, when the new, at that time this FCRA 2010 and rules 11 had come, the Joint Secretary himself used to come for outreach workshops, and in few of the workshops we also had participated. In one workshop, one participant asked the Joint Secretary of the FCRA department that, look, now commercial transactions are not permitted, so can we take a commercial borrowing from the donor which is repayable? So would that be treated as grant? Because since as per the contract it is repayable with interest, so can it be treated as out of FCRA? So the Joint Secretary replied that the onus will be on the organization to establish that it was a business transaction in the normal course. Is the donor a bank? Is the donor otherwise give such loan to everybody? All citizens and entities of India access that kind of loan? So therefore, it will ultimately be treated as a colorable transaction to evade the law. The law has changed and you rework that. So unless you are absolutely sure that the service contract holder otherwise is a commercial, known for such commercial entities, and there are so many clients to whom it is giving, don't become the sole client, and then maybe it will be a kind of a camouflaged transfer of. And right now, the FCRA department has taken up such cases, some of the reported cases, I'm not naming, even in some cases, the department has filed FIR with the Central Bureau of Investigation where the registration or prior permission was denied those donor and the local institutions, they created private limited companies and gave commercial contracts, and FCRA department said that even though the contract is signed as a commercial contract, it is a camouflaged contract. Actually, FC money was transferred. And because there are criminal cases being filed in the past, so one should be very careful, because the onus will be on the organization that it was an arm's length commercial contract where anybody could have participated and that particular organization was given.
Sandeep, you are muted.
Sorry. So let me continue with this declaration issue, and I would like to come to this declaration 14, which is extremely confusing to large part of people. Is that it says that any organization entity not belonging to the association is being managed or financially supported by the association. Now, what does managed and financially supported mean is one issue. But what I would like to do now is that I will quote some of the, or I will read out some of the instances. And if you can tell us whether that would mean managed by the association or not. Now in the context of subgranting not being permitted, different permutations are being worked out. So in that context, I'm raising this issue, whether this will fall under being managed category or not. Now, number one, for example, if the lead agency or intermediary agency does a consultancy contract with the staff personnel of the implementing agency, you have a consultancy contract with the implementing agency, will that tantamount to managing that implementing agency? Dr. Foglan.
There is nothing called a staff of the implementing agency, because it must be a former staff of the implementing agency. So as I told in the beginning, so all the contracts have to be closed, and if that staff contract is terminated by the implementing agency, and whoever can implement, including the mother NGO, directly implementing the program under the normal recruitment process, the staff is getting an employment there. Now, one is to understand the difference between a consultancy and employment contract. We very easily say that I will give a consultancy contract, but a consultancy contract will have to come with certain specific expertise on the part of the consultant. There has to be invoicing, there has to be delivery. But if there is a contract where a person is reporting to somebody, where the person is having a place from where he has to work, then such contract are employment contract. By saying them these are consultancy contract, they will not become consultancy contracts. So now one person can engage with a individual who might be a former employee of any agency, but that person should not continue to have any kind of relationship with the implementing agency. And in a normal course, if they can hire other consultants, they can hire that staff also.
Right. So I think that is very clear that, existing staff of implementing agency, one should not have a consultancy contract or any other form of employment contract. Otherwise, this declaration will be necessitated. Now, we also get to hear that, similarly, lead agency or intermediary agency are hiring staff of implementing agency as volunteers in volunteering capacity. If they hire as volunteers, do you think it needs to be reported under declaration number 14?
No. As I said, that the declaration 14 is about one particular charitable institution. So the declaration 14 is that whether you are controlling, whether directly, indirectly influencing the work of an implementing organization, or you are working through an implementing organization. But if you are working with a person who has no relationship with the implementer, he might be a former staff, but a current staff of the implementing agency, using the bank account of the staff, giving program advance to the staff who is an employee on the other organization. These are the kind of transactions in the past also have been subject matter of investigation and determination of fact. So we cannot, because there will always be a counter argument when you say that whether you can do or whether you cannot do, because these will be subject to fact finding, and the onus will be on the organization who is engaging into this kind of transaction, and it may become difficult to justify if a proper inquiry is being taken, if that person is continuing as a staff and the same person bank account is used for program advance or as a through a consultancy contract, and all those kind of arrangements through those subject to individual fact finding on the face of it are not recommended.
Right. The other one, with related to this aspect again is, at least for example, these network projects. Now there used to be a lead agency and sub agencies or grassroots level organizations on ground implementing. Now in the revised scenario, just hear this out. If the donor agency is directly giving grants to implementing agencies, just for the sake of convenience, I'm using this word implementing agencies, and the lead agency, the erstwhile lead agency, is given a contract to provide accompaniment, monitoring, handholding support to these implementing agencies as part of one contract alone, will that constitute as being managed?
Now we have to understand that what is monitoring. One, monitoring, suppose say audit, suppose say evaluation of a program. So these are the kinds of processes which are independent of the program, because to continue the program, to map the efficiency or the impact of the program, the donor and other agencies, including the government agencies, they conduct social audits, evaluations. So any activity which is independent of the program, monitoring normally is not an activity which is independent of the program. Monitoring activity is normally a part of the a program, where the monitoring agency plays an integral role in the implementation and the delivery of. So just taking apart the grant part of the which was mother NGO and converting into a service contract may not be feasible, because suppose a donor gives a kind of a monitoring contract which otherwise was a part of a charity program. It was not like an evaluation or an audit. It was a part of a concurrent activity of the delivery of the program. Then the mother NGO who is taking the service contract would be working on behalf of the donor agency. And if the donor agency itself is doing something which is a part of the delivery of the program, it will deem that donor activity is having activity in India. Donors don't have the right to have activities in India. Therefore, their commercial contracts should be in the nature that which are independent of the contract. They may hire a lawyer, they may hire an auditor, they may hire an evaluator, but monitoring may be a donor's oversight point of monitoring. A donor may keep an oversight on just the way the donor takes a 6-monthly report. That is also a kind of monitoring and oversight of the program. Those kind of work may be yes. Otherwise, these activities, one are like programmatic activity. Two, they would form a part of the admin part of the expenses had this been a charity contract, had inter-charity donation been allowed. So only because inter-charity donation is disallowed, then this admin portion of integral part of the program becomes a service contract. As I said, this one has to be careful to three things. It should not be deemed as an activity of donor, because donor cannot have activity in India. So they cannot do any particular portion of the program through a commercial contractor. The onus will be on the implementing agency that this monitoring is totally independent of the program. It is not related with the program. It is like an audit activity or that kind of an activity. So it is extremely difficult to replace the role of the mother NGO with a service contract. I personally, I don't recommend that.
Right. So I will now move into the, I will now take up the questions from the participants that have been written down in the chat box. But before I do that, Dr. Patra, something which is very important is with regard to this notification that has come on 23rd November. with regard to FC4 filing, and now it says that it has been extended till 30th June 2020. Now, in that context, 4 things has been listed down, which Mr. Kejriwal also presented during his presentation. It says that you need to mandatorily open FCRA account in SBI, upload Aadhaar details of all office bearers, upload affidavits of all members, and obtain the Darpan ID. So do these things become mandatory in order to file FC4 now? Without doing this, can one not file FC4?
Right. So, by implication, somehow it has become mandatory, even though the act or the rules don't say it. But by issuing that public notice and also by linking it to filing of returns extension, somehow the department intends to make it mandatory. For example, Darpan ID earlier was not mandatory, but it looks like it will become mandatory. The affidavit has to be uploaded, Aadhaar and FCRA. Now, in any case, if we are not doing it now, we have to do it before the renewal application is filed. So in that case, whether it is mandatory or not at this stage, assumes very little significance. For example, there are some questions in the chat box which said that we have already filed a return. What should we do? So if you have filed a return, good luck, you have done well. Before the new form has come, but you can't escape very far, the June is coming. So by June, you have to comply with these things. So there's no going away or running away from this. So this is going to come, or it has come. So therefore, I think ideally this needs to be done before the June renewal application.
Right, I think so. Now I will like to take up the question from the participants. Well, you answered this one already, that even if you have filed your FC4 for this year, the other formalities that is prescribed under this notice of 23rd November needs to be fulfilled. The next question, Mr. Kejriwal, is what it says is that can a farmer producers company receive support from NGO as direct implement? Will it be direct implementation? So, providing financial support to farmers producer organization out of FC fund, will it be permissible?
I think the question is whether the farmers cooperative study requires FCRA registration or not to receive foreign fund.
Right.
If that is the question, then I think the word association is wide enough. The word association is wide enough to cover every sort of organization having office in India. To come under the definition of association. And now, if they are receiving fund for a definite purposes, I think they are being regulated. The confusion arises because the term person, they have included only the term Section 8 company. So meaning thereby, all other companies, as per the companies are exempt. So that confusion has arises, but my understanding is that the term association continues to be very, very wide. And if producer cooperative society intends to receive foreign fund for the defined program, I think they should have a FCRA registration.
Right.
The issue here is that whether the transfer to the farmer producer company will be deemed as end utilization or not. Now, if it is deemed as end utilization, then it is all right. But if it is not deemed as end utilization, then it will become inter-charity donation. And that is not permitted out of FCRA funds. So in our understanding, like Mr. Kejriwal has said, I don't think this will be considered as end utilization if it is transferred to an intermediary agency, which is a farmer producer company.
Right. So farmer producer company cannot be a beneficiary in itself. So that is what is coming out clearly. Now, in the context of this amendment to Section 7, the question is if fund transfer to co-applicant will be treated as sub-grant. Now, especially EU project, two organizations have jointly bidded for a EU project and it has been sanctioned. Can, in such case, can fund transfer to a co-applicant is permissible, Dr. Fogla? Will that be permissible after the amendment of Section 7?
No. Fund transferred from the lead agency to the co-applicant?
Yes.
From the overseas donor to the co-applicant?
From the lead agency to the co-applicant?
No. All kinds of organizations, registered, unregistered, because we have to understand the new act has now extended the bar. All kinds of transfer to any kind of organization was already prohibited under FCRA, because you had something called Rule 24, where you needed permission to transfer to organization non-FC. So FC, non-FC, all kinds of registered, unregistered, any kind of organizations, no fund can be transferred, only direct utilization from the bank account. So that is not possible.
Right. The next question, Mr. Kejriwal, I think we have answered this already, even though I would just ask you, is that can we go for FCRA annual return? Can we fill FC4 or wait till we change the bank account? Wait till we open the bank account? I think the answer is
so far changing the bank account is not compulsory for submitting FC4 return, though it is made compulsory for submitting renewal application or submitting the application for new registration. But for submitting FC4, this opening of bank account is not compulsory. The confusion is created because of this public notice, when they have given these 4 conditions, 4 situations for which they have to extend the time limit. But under the Act and rules, there is no such requirement.
Right, right. Dr. Patra, the question is that can an NGO whose application for renewal of registration was submitted in February 2020, and it is still pending with FCRA department, and in the meantime the registration got expired in October 2020, can this organization continue to utilize FC fund? I think we dealt with it, but still it come as a question from the participant.
Yeah, so according to the amendment, they cannot. That's, I think, very simple and clear now.
Right, right. So that is pretty clear that it may not be possible now because of the amendment that has come in. You know, this question comes up during different discussion with NGOs. Dr. Fogla, what happens to balances with the implementing partners given by mother NGO? Can it be returned? You know, now that the contract is not enforceable, can the balance fund be returned to the mother NGO?
No, because under FCRA law, the mother NGO and the implementing NGO are both on par with each other. So therefore, if the money is returned, because normally under accounting, under FCRA, for statutory purposes and accounting purposes, each transaction, whether it is given or refunded back, it is treated as inter-charity grant. So I don't think unspent balance should be returned. The unspent balance can be utilized by the partner. The unspent balance, or a donor or the mother NGO may make a list and apply to the FCRA department and seek a special approval to receive it back. But I don't think it should be taken it straight away, because it will create needless confusion, because this FC4 declaration, it has to be declared that the money was given to another FC registered organization, and it may initiate another inquiry, because it has to be reported and it is not advisable. So better to go for a permission and maybe contact FCRA support and seek a formal permission. Right,
right. I think the advice is very clear. Now, this is another issue which is coming up with regard to filing for change. And many times the earlier change application, whether it is pertaining to board member or change of address or change of object, whatever is pending. Now, in that case, when you are filing for renewal, Mr. Kejriwal, what should we do? Like, let us take an example of change of board members. We have filed for a change of board members, but it is showing pending. Now, in that case, what can one do? In the context of filing for renewal application, what should one do?
So there might be 2 situations. The board member have changed and you have submitted form number FC6E that has not been approved, or in some cases they have not even submitted form number 6E. Okay, and they are going to submit their renewal application. Now the renewal application is pre-filled. When you open your portal in your login, you will find the FCRA renewal application is already filled in with the name of the board members as per their record. And now there is that filling option also gives you to make edit. So at the time of filling the FCRA renewal application, you can edit the filled in portions and submit the list as per the current date, but make it a point, you must submit the FC6E if it is not submitted with all the changes, because FC renewal is not the form for intimating the changes. The FC6E is a form for intimating the changes. If intimation of changes has not been submitted, after submitting FC renewal or before submitting FC renewal, you must submit FC6E. But pending that approval, you can submit FC renewal form by editing the list of board members appearing in the pre-filled form.
Right. Very quickly, Mr. Kejriwal, can this SBI account be a savings account, or it has to be a current account? What is the?
I think there is no bar in that. Some of my client has opened already a saving account with SBI. So I think SBI is not till date has the distinction between current and saving.
Right.
So already saving account has been opened.
Fine. Oh, so now this one to Mr. Dr. Fogla. Of course, you've dealt with it, but since it has come later on in the chat box with this confusion with regard to this 12.5 and 12.6. 12.5 says ceases to exist, and 12.6 talks about the conditions under which it will cease to exist, the registration validity. So shouldn't we consider 12.6 and not 12.5 for the purpose of understanding of this provision?
What exactly is the question that under 12.6 you are just
it says that, is rule 12.5 applicable to those organizations whose registration has ceased to exist? In rule 12.6 there is a clarification on when the registration has ceased to exist. Soon the clarification in rule 12.6 be used to understand when 12.5 will be applicable.
So Surajji, would you like to take it?
Yeah. Actually, Sandeep, Rule 5 says the situation where your registration certificate expires. Now, Rule 6 is a deeming provision which says if you have not applied for renewal or you applied for renewal without filing fees, then your certificate shall be deemed to have been seized. And in that situation, you're not allowed to utilize the FC fund, but at the same time, your FC asset will also rest with the government till the renewal is granted to you or till the registration is renewed, the new registration is obtained by you. So 12.5 applies for all type of seizure, but that talks about only for non-application of FC fund, but for the deeming provision, only for these two situations, when you have not applied for or your application is without application fee, then additional problem is your asset will rest with the government.
Right. I think that clearly explains.
So that is coming from the difference between 12.5 and 12.6.
Right. Dr. Fogla, this issue, let's say our FC registration is suspended on 15 February, for example. So until date, there is no response from FCRA department. So do organizations like these need to open a new bank account in SBI whose registration is suspended for the time being?
The registration is suspended, but the certificate is live.
Certificate is live, yes.
So the organizations whose registration is suspended and 180 days has elapsed, and the organizations whose registration is suspended 180 days have not elapsed prior to 29 September, those organizations has to be distinguished. If an organization's 180 days has elapsed prior to 29, because after 29 September, those 118 days, if the proceeding is pending, then 180 days could be converted to 360 days. So, because if it is within that 180 days period, then they should contact with the FCRA department, and if the 180 days are completed within this 31st March of opening of the bank account, then they should wait for that, because their bank account etc. are under seizure. They cannot move, because the idea is that the funds etc. everything will all FC fund will vested in the main account, but the entire fund and other things under formal seizure by the government. So they should wait for the completion of the 180 days period. 180 day period is completed, then there under the law there is a deemed revocation, but under FCRA law this revocation has to be effected. In many organizations, either by engagement with the FCRA department or through judicial intervention, this 180 day was removed from the date on which 180 day was completed. So it was removed retrospectively. Therefore, technically they are eligible for opening of the new SBI account, the date 180 days are completed.
Right, right. So technically that possibility is there. One question is that since this FCRA amendment talks about vesting of asset in any case until your registration is valid, is there a provision to hand over the assets back to the donor? Is it possible to give back the assets to the donor while your registration is live?
The donor, the foreign donor or the Indian donor, which is mother
It just says donor. Now let us say both cases what will happen. Indian donor and foreign donor.
No, foreign donor transfer of asset is unusual. Normally balances are transferred, and we say that if it is normal part of the contract and due to a force majeure or a circumstances or a violation by the implementing partner. So if it is not under the normal circumstances, it should always be with and permission of FCRA department. Under normal circumstances, it is a contractual thing. If you can receive, you can pay back. So there is nothing in the FCRA law which says that you cannot pay back the balances to the donor, but still when the amount is considerable, the recommendation is that you should take permission to repatriate money outside the country, and it may have some implication under the income tax law as well. And the same will apply to contribution in kind. Of course, transferring assets physically back to a country outside the country may have its own practical and logistic issue. But maybe we can take it that it is recommended that in such cases and in the current prevailing circumstances, a petition under Section 50 of the FCRA should be moved. You're mute.
Sandeep, you're muted.
The question is that can fixed deposits be made out of existing bank accounts? Can you make fixed deposit out of FC funds? That is the question. There is no such.
There is no bar.
Yeah, the only bar is on speculative investment. That is what the Act prohibits. Other than that, fixed deposit are not considered speculative in nature, and therefore you can use FC funds to do that. But as we discussed in the earlier session, we said that normally you should do it out of SBI bank only, preferably when you are making any such fixed deposit investment and so on. Now, so the question is that what if a trust has several projects and each project has separate donors and all have admin expenses? Will admin be considered separately for each project, Mr. Kejriwal?
No. This admin expense limit as per FCRA is for the organization as a whole. Nothing to do with the donor-based calculation. One donor may be 100% foreign admin expenses, another donor may be 5%, third donor may be nil. But for FCRA purposes, it has to be overall organization, not donor-wise.
Right. Dr. Patra, will capital expenditure be considered as administrative expenditure? How will it be treated?
This is a separate category. There is admin expenses, program expenditure, and capital expenditure.
And in FC4, you need to report it separately. As far as capital expenditure is concerned. So that requirement is there. Now this is a very. It says that I am acting as a development director and program implementer. But I am secretary too. Is my honorarium will my honorarium be considered under admin? I am getting honorarium as development director, not as secretary. Dr. Patra, Dr. Fogla, anyone?
I would like to address this generally. There are a lot of questions coming whether this is admin, whether this program. I think we should not. We should refrain from giving a generic answer. There is a larger framework of Rule 5 which we have explained, but each organization may have its own specialties and special circumstances. So if you have a very special circumstance, write to us. We need to examine it and probably tell you, because otherwise it will be very superficial and you may get a wrong advice, and then we don't want you to get into trouble, because this is not some simple straightforward answer like this, because we have to see the budget, you have to see your actual implementation, the way you have accounted for it, and how you are reporting it. So it has to be seen in totality.
Right. I think that's a very fair advice to give. It's difficult to give a generic response to questions like this without understanding the realities. I think this one, Dr. Fogla, you already responded, but since it has come, since re-granting is not possible, will it be possible to refund back funds outside India to the main donor?
Already explained.
I think it has already been answered. You can apply to FCRA department under section 15. Special provision is there. If FCRA department grants permission, then you can do it. Otherwise, it is not possible. Last question that I can see from the sheet that has been provided to my team is that if you have applied for renewal within stipulated time and now the registration has been expired, application has not been denied or approved or it's pending, can we utilize the fund? I think even this was already answered. Once your validity is over, you cannot use FC funds or you cannot receive further FC funds. So these were the questions that has come, and I hope we have been able to answer all of these questions. Our panelists have been extremely generous. They have stayed beyond the time. We were originally supposed to close at 5. So last word, any last word from any of the panelists on this FCRA amendment rules? Any last advice or a last bit of thing that you would like to?
Now, every NGO has to be FCRA compliant. They have to hold their FCRA registration. Otherwise, either you surrender, either you don't make it renewal, or it is cancelled. Your asset is going to be wasted. If you want to save your FC asset, you have to hold on your registration. That means you have to comply. So comply.
Okay, so comply is the message. Dr. Fogla, we would definitely like to hear one word from you.
As Surajji said, the government, there is a clear-cut pattern in the past. In the 4 years ago, under the Income Tax Act, also a rule came that if the registration, 12-way registration is cancelled, all the assets will be taxed at market value. And it is not possible for many organizations to pay that kind of taxes. So a charitable organization this should be compliant, and at least should not face cancellation proceedings or punitive measures because of apparent violations. A renewal, non-renewal, surrender, those can be fought in the court of law, but a cancellation or a stated violation which is proved, then it will be very difficult, and it will be very difficult to handle, because under the income tax law also, for FCRA violation, 12-way can be cancelled. And once income tax registration is cancelled, not only the assets will be vested in the FCRA authorities, but the tax on the assets at market value under income tax law also will be paid by the organization. So it may open up a Pandora's box. So we should refrain from doing doubtful practices. Whatever we are very sure, those kind of things only we should do. And that is where I think in terms of compliances, times are difficult, and quite a bit of onerous responsibility is there on the people who are managing NGOs.
Thank you very much. Thank you very much. Dr. Padra, your turn now. Last word.
My colleagues have already said, it's basically what has already been said. I don't want to repeat, but what I want to say is that, the law may be difficult, but compliance is important. Don't interpret selectively the law to your advantage, because the law will be interpreted differently by the law implementers. Then you will be in trouble. For example, you can say, oh, we are an organization, we work in village. How can we not pay more than 10,000 rupees cash or 5,000 rupees cash? Those kind of things we try to do, and we try to take advantage. But then the law has whatever are the laid down principles. So please don't violate by selectively interpreting the law in your favor. If there are confusions, please get back to experts who would be able to guide you properly. And like Surajji has said, and Dr. Manoj also has said, that protecting our registration is of paramount importance. And those are the sign of the times. Thank you very much for this wonderful opportunity.
Thank you very much. I think the message is very clear. Compliance, as Surajji says, that's the most important part. Once again, on behalf of the panelists, FMSF, I would like to thank all participants for their participation today. I hope it has been enriching one to you. If you have any further doubts, clarifications that you need, please write to us. You can, our email address is given in the form that you have submitted earlier. We would be happy to respond to you. We are also planning to host a special webinar focusing on renewal, aspect that will be announced soon as to when we are going to do it, and we would invite you to be part of those webinars also. Thanks once again. Good evening, good day, wherever you are based, depending upon that. Until we meet next time, bye-bye. Thank you very much.
Thank you. Thank you, Sandeep.
Thank you. you.